Excellent, thank you. Good evening, everyone. Hello, and welcome to our third faculty forum from BTRM, or CERT BTRM, as I should say. Always, we like to think a topical subject of importance to ALM practitioners in the city. Forgive me, I've had a Fox's Glacier Mint. And this one is, again, continuing that tradition of an important topic for ALM practitioners. What centralised clearing means to banks, CFOs, CROs and treasurers, the impact of CCPs on collateral management and pricing. That should actually say the impact of the introduction of CCPs. In other words, what does central clearing mean for users of derivatives? Whether one is a market maker in derivatives, obviously a very big impact. Whether one uses derivatives to hedge as a bank or a non-bank FI or any other participant in the market. What is the impact of the introduction of centralised clearing? I would suggest right at the start that it's quite material. Obviously, if one is a market maker, definitely so. But even if one is a user just for hedging purposes, it is also material. And therefore, ALM practice in any of these institutions needs to be up to speed to address the concerns being raised and to check that it's up to speed. Okay, so in the interests of knowledge transfer and discussing this topic and make sure that we are up to speed in the City of London, we've got the third faculty forum for you on this topic, and I have an esteemed panel to discuss this topic, which will enable me to sit back and finish this Glacier Mint and leave them to do the talking. From my right, close personal friend of mine in BTRM faculty, Peter Eisenhart. We were having a chat about how far we go back, and it's at least 16 years. Colleague of mine from JP Morgan days. Actually, he was JP Morgan, I was Chase, but those two institutions merged, of course, in 2000. Next to him, a new faculty member of BTRM, Massimo Pedroni, who is with Prometea on their international business practice, actually home-based in Milan, am I right, Massimo? But a frequent visitor of London, like so many cultured Italians these days. London, right? On my left, close personal friend of mine and another new faculty member of BTRM, Colin Johnson, who was latterly West Bromwich Building Society, Lloyds TSB and Santander, and is chairman of the UK ALM Association. Nice to have someone from UK ALMA appearing at a BTRM event. Sorry, Colin, I couldn't resist. And next to him, of course, close personal friend of mine. We don't go back 15 years, more like 5 years or 6 years approaching. Ex-RBS colleague, now, of course, with... He's not on your sheet, but you, of course, saw him earlier when he presented with... would you like to say, Kevin? Remind me.
Solum Finance.
Solum Finance. I always call them Solum Capital, but they're not capital, which makes them sound like a hedge fund. Yeah. They're Solum Finance. But as I say, we were colleagues at RBS GBM a few years back. And I would like to say he is a new member of the BTRM faculty panel, but I've yet to persuade him to do that. So maybe next time you come back for a faculty forum, he'll also be on the BTRM faculty. Right, excellent. Okay, so we're going to kick off in time-honored fashion. I will invite each of the panellists to make an opening address on this topic from their own personal perspective, of course, and then we'll debate the points that they raise. So why don't I start with Massimo, to my right, on what CCPs mean for ALM practitioners.
So, I think we can identify impact from several standpoints. So for sure, we have impacts in terms of pricing. We discussed a lot during the previous presentation about the impacts that the CPP and determines in terms of swap pricing, in terms of pricing of derivatives compared to the old approaches that were used to price derivatives under the CSA. So now the methodology to price derivative swaps and in general anything is cleared to the central counterparty. It's much more complicated. Implies the use of new conceptualization of understanding what is the cost of the initial margin, the cost and the revenues generated by the variation margin. We have, of course, phenomena on intersection with CVA, BVA, FVA, and so on. So one major impact that I see from the centralized clearing is on the methodology used by the Treasury to assess the value of their swap portfolio and to understand what is the fair pricing for the derivative transaction. So from this standpoint, new competencies and skills and a methodological framework must be developed within the Treasury Department, within the ELM unit, in order to understand better the impact of this new settlement mechanism on the quote that you can get from the various counterparties. Another important issue, of course, is the organizational impact. Everybody stressed today the importance of establishing a collateral optimization function in order to address questions like which is the cheapest collateral to deliver, which kind of collateral can be replaced from one clearinghouse to the other one, which kind of desk should use the available collateral inside the bank in order to maximize the profitability, and from the other one minimize the risk-weighted assets for the bank from a capital perspective. So where the collateral optimization function should be placed and how this function should interact with the trading of the the Treasury Department is for sure a key issue to address. And the third one is, of course, related to how to steer the hedging activities of the Treasury. So the CPP is facilitating or not the life of the Treasury in addressing the right strategy, for example, for hedging the banking book. We know that dealing with the CPP forces a little bit to use more standardized, more vanilla products or instrument. Maybe these kind of instruments are more suitable from a clearing perspective. They are more economic from a collateral manager perspective, but they are not the most suitable hedge for example, the interest rate risk in the banking book point of view. So they are not exactly the kind of hedging strategy that you put in place in order to close your gap and to stabilize your net interest income. So I see three main areas of impact in terms of methodology, in terms of organization, and in terms of actual ALM steering within the Treasury Department.
Excellent, thank you, Massimo. There's a lot there. We'll pick up all of those actually in due course. Mr. Eisenhardt, do you want to take that?
Yeah, I guess I would come at it from the regulatory side of things. I guess for a change, maybe we have some relatively good news on one front, because in February, the EU and the US agreed on this matter of CCPs to agree on the principle of equivalence. And that means I'll consider your regulation, the Americans would say, I'll consider your regulation in Europe good enough for me, and you consider mine in the US good enough for you. And this is going to save a lot in terms of capital and margining and collateral. And this was something of great concern. Now, generally speaking, since the crisis, there's been a rush to regulate, and there's been a lot of local variations in regulation. There are these great G20 summits where a lot of finance ministers come together, and they agree all sorts of wonderful principles, and when they go back home to implement it, it's all lost. But here is a win, and I think here's a case where we had to win, because it really was going to mess up the basic liquidity of the derivatives markets on a global basis. I guess my second point on this is IOSCO, which is the global regulatory body in Madrid. 2 days ago, they came out with their annual report of the biggest risks to the financial system with respect to securities markets. They talked about cybersecurity, they talked about mis-selling to retail investors, they talked about bond market liquidity. Of the things that keep them awake at night, the fourth risk they mentioned was collateral. So they're still concerned about collateral. They're looking hard at the implications of a lot of the collateral swaps, the demand for collateral, how much that's going to affect us. I think on the CCP front, the G20, when they met in Shanghai just last week, they were concerned about the problem of recovery of these CCPs and systemic risk of CCPs. So I think we're going to hear a lot more on that front. There's lots of talks about who's really on the hook. Fund managers around the world are up in arms because big fund managers are told that they've got to go through CCPs. They do it through a bank. They don't want to be part of any recovery or resolution process, but we'll see how that all turns out. And it's all a question of how much capital should be in the CCP itself.
Okay, excellent, thank you. We'll pick that up as well. This is what I'd like to state about the up-to-the-minute nature of BTRM. How many other events have we been to where the speaker would say, just 2 days ago we had this? Excellent, right. Mr Johnson, please.
Yeah, I think if I kind of go back through, what you say, my CV to when I was at a smaller institution from a purist ALM point of view. When I first started there, they had no ALM function, and everyone said, well, what's ALM? It's all about managing the assets and the liabilities, and you kind of get into the conversation, well, what's that? It's everything. And positioning yourself holistically at the top of the balance sheet. And the first thing that the whole CCP thing does is makes you realise that it's not just market risk now, it's credit risk. And you've just taken over a big chunk of credit risk into the ALM world, which is great because we like owning things. But also the importance of that in terms of thinking holistically and managing those offsets. And I would say the big thing that kind of concerns me about it is in my simple world as a treasurer of a small institution, it's another nail in the coffin of using derivatives, where you used to think derivatives were a great hedging instrument, so I can hedge my risk. And what you realise is actually it's a transfer, it just changes the risk into something different. And, when IAS 39 came along, everybody started going, oh God, there's a real admin burden to derivatives. And what we've done here is then put another secondary one. And, I mean, the speech was fantastic in terms of all the detail behind it, but how many of the people in the, relatively small institutions can get down to all that technical knowledge, and how many will just go, actually, I'll just live with a little bit of interest rate risk because I understand that. Whereas if I try and do a derivative, what I do is I get rid of a risk that I'm comfortable with and transfer it into a pile of risks that I don't understand, and people talk to me about XVA and KVA and things and go, I've got no idea what they're talking about, and I'll just nod. And I think that's the one thing that really kind of concerns me and I think it comes back to your comment in terms of, price makers, price takers. For the price makers, it's fantastically important to understand all this. For the price takers, you want to go, I want to do a swap, I want to get rid of my risk. What's the price? I either do it or I don't. The last thing you want to get is another pile of random risks that you don't really understand and don't want to have to find out about. So that'd be my concern on it.
Thank you. Thanks, Colin. That's excellent. In fact, I'll take that up right after the last, because I want to address that. If we don't use derivatives, then what do we do? That reminds me, by the way, you rattled off the XVAs. Topical subject, very important, absolutely. I myself have been involved in some debates with none other than an august personality than Professor John Hull about something like FVA. That was a few years back. It just reminded me of a time when, and Mr Liddy will know this person, because myself, Mr Liddy, and a former colleague of both of ours, Tim Evans, in fact, were in a meeting. Tim is someone I'm very happy to pass on regards to if you're in touch with him. He's a top man, got a lot of time to search for him. The three of us were in a meeting with someone who shall remain nameless, a long meeting with forgive me, but this is an important anecdote, with the regulator, and this person, one of our colleagues, who shall remain nameless, was going on about collateral management, and these things came up, and the quote next day amongst the three of us was, do you remember? Did you notice how he spoke a lot, but he didn't actually say anything? Do you remember? See, you know exactly what I'm talking about. The point is exactly right. A lot of people are talking about this. The risks we have, whether we can measure and quantify, and we are aware of CVA and FVA and KVA. But what does it really mean? Are we really au fait with it? And I think there's a lot of practitioners who, instead of simply saying, right, we need some education on this, are kind of bumbling along, and that's a danger for us. So that's an important point. We'll come to that in a second about what to use if we don't use derivatives. Mr Liddy, I thought you could have the last piece, because everyone said all the important points, but I'm sure you'll still have a few more important points to add to that.
I think, for me, I'm going to pick up on one of the things you said. I mean, the question about using a derivative or not using a derivative is an interesting one, because you said, I understand the risk that I have if I don't use the derivative, and if I do it, I eliminate one risk, but I get a lot of other ones. And to me, so what? My primary objective is to get rid of the interest rate risk in the banking book or to hedge the balance sheet or whatever. Now, in doing that, I get rid of run risk and I have some other ones. As long as I understand those, I don't see why there should be an issue. For me, the most important thing is how does my institution fit together in terms of who funds the derivatives balance sheet? What are the pipes in place for moving the collateral around? What is the transfer pricing mechanism that ensures the right behaviour happens? How is that risk picked up? Now, if in Europe we now have prove-out, right? So you're effectively enshrining all CBA, FBA in your prudential evaluation now. So it's a risk that is the regulators say is there. Not only do they say it's there, you have to value it prudently. So I think I might have taken it out actually because I thought it might be a bit too inflammatory, but I put up there the TLP capital arbitrage as one of my bullet points to talk about, because under the AVA, under prove-out, additional valuation adjustments, one of the things they say is that, okay, if you have a funding valuation adjustment, how prudent is it? Are you using your external unsecured curve, or are you using something else? Now, if you speak to most banks, they use something else. And they tend to have all gravitated around, somewhere around 75 basis points is what they charge. But most banks will fund much higher than that, and certainly their unsecured curve is higher. So Pruval says, I want you to take an additional valuation adjustment up to your external unsecured. Where we see the arbitrage is banks are saying, okay, fine, I'll take it through capital. I won't take it through the P&L, right? Because it's 100 million in P&L, but it's 100 million in capital. That 100 million is going to get buried in billions of capital out in the balance sheet, right? And therefore, I'm going to carry on lending money at 75, and I'm going to carry on funding my balance sheet at LIBOR plus 150
Until I have no capital.
Yes, exactly.
So so I said understand your risks and have the pipes in place, but we're already starting to see the capital TLP arbitrage. Right? I won't pay the TLP, I'll just take it as a capital deduct. But I think the key point I would make is boundaries, the boundary issue and incentivisation. Unless the institution is joined up in terms of its treasury and its trading, and the Treasury understands what trading is trying to achieve, and trading understands what Treasury is trying to achieve, and having the right pipes in place and the right TLP in place to drive the right incentives, then you're going to fail, right? And then you're going to have internal arbitrage, and you know where that leads. And that's the point I'm making.
Thank you very much. That's excellent. Now, to be fair, Colin's point was exactly that. I have one risk that I understand. Is that better than transferring it away to get one that I don't? Your comment was, as long as I understand that second, it's okay. But that's actually the point. The one risk that they take on in exchange, I would suggest a lot of practitioners don't understand. That's the issue, and I think that was your point, right?
Yeah, I think you'll know in terms of the pipes that you have in place in the smaller organisation is non-existent.
Absolutely,
but you don't bother transferring all that internal stuff because you're managing for the balance sheet.
But it's not limited. I would say there's quite a few desks of individuals in large institutions that don't get this either. Let's not think for a second that unfamiliarity with this whole XVA, the impact of CCPs is just limited to I say they're no longer, right? I was about to say Derbyshire Building Society, but I'm not sure if they trade anymore because Nationwide took them over. What I'm saying is it's not limited to that from my own personal experience. But we'll come back to that. This is actually a very important point. It's the org structure is an issue, the incentivisation, the way you organise the bank. This becomes beyond a technical point, just understanding the technicalities of CCP, IM, which I'm going to pick up right now. It becomes more of an op model. How have I organised the bank so that incentivisation is the correct one? I mean, if I'm the capital TLP arbitrage sounds like something that's fundamentally wrong. It just sounds like something that one should not be doing. If I was the shareholder, I wouldn't want the institution to be doing that because it's contrary to what I'm trying to do to build long-term shareholder value added. Granted that nowadays people are just quarterly returns type of people. If I had a long-term view, it would be the wrong thing. Let's come up to that, all right? Let's come back to that. First, just stick to the technical because it's easier to debate. Can I just follow up and let's just get everyone involved in this? Massimo, your point, the impact is that you mentioned three things. One of them was pricing. Can we just get a bit more detail? what is the impact on pricing? So you said the methodology of pricing it needs to be looked at. And I think you started, but you kind of informed this to an extent. You started the debate. You said understanding the cost of IM and the impact of VM, variation margin, on the pricing. What is it we should be being aware of and revising to check that the pricing is the more accurate one? Okay, because if I'm, by the way, I completely agree with you. But if I'm just an interested layperson on the street, and I think CCP. Previously, I'd settled bilaterally, and we had CSAs. Now I'll have an agent with the clearer, or I'll deal directly with the clearer, and everything will be centralised clearing. That's fine. That's a collateral management issue and a clearing issue. Why should the price of the derivative be different? Of course it is. Can you just go into a bit more on what actual parameters impact the price?
I think we came from a classical textbook analytical framework that maybe all of us studied at university, in which we price, for example, interest rate swap using the typical risk-free curve. So the risk-free curve that you can use, I don't know, the swap curve or the 3-month LIBOR curve, is something that after the international crisis probably no more any longer exists. It's a concept probably outdated that reflects the situation in which the liquidity is extremely cheap, in which the various counterparty can trade freely, generating zero arbitrage between the various markets and so on. Now, taking into consideration variation margin, initial margin, cost of collateral and so on, means that any single institution must look at its own cost of funding, consider its own creditworthiness, and also the characteristic of its own single counterparty to which it trades the derivatives, in order to understand what is the fair price of the transaction that is putting in place. So we are moving to a pricing framework which is theoretical, a sort of one-size-fits-all model, to something that must really take into consideration the funding spread, the credit condition of the bank, the single rate at which the Treasury can settle its all account, and for example also the fees or the commission structure that the various clearing houses are applying for the clearing, for the central clearing, or if not the CSA condition when you are bilateral netting. So just the distinction between bilateral netting and central clearing is something that in the traditional pricing formula, pricing method, was not considered. Now it becomes a very clear and key distinction, and probably leads to complete repricing, to complete evaluation.
Okay, thank you. The bit on using your genuine cost of funds, I get. I remember having some debates back in GBM about that. That I get, and that's a post-crash thing. The impact on the second point was what were you saying, Massimo? Just remind the impact, the cost of funds. I get. What was the other bit? The understanding
the price of your counterparty.
Right. Okay. So that should impact the price of the derivative as well.
Because we are moving to in the CCP, we are moving to a situation in which we deal with the central counterparty, but the central counterparty, as we said in the previous presentation, brings credit risk in itself. Even if
isn't the centralised counterparty meant to be a bit like dealing with an exchange? It should be risk-free, shouldn't it?
It shouldn't. We saw in the past that.
I'm giving you the theory. I'm giving you the theory. Let's have okay, fair enough. I take that. Any comments on that? I'm totally with you on this one. Any comments on that? Anyone want to say anything in addition to that?
I'll add on the pricing. In the bilaterally, you're right. The change from using what was perceived as the risk-free rate, which was 3-month LIBOR. I've always felt that the concept of risk-free rate was not actually the right one. It's actually, how do I fund my derivative?
Yeah.
Because if I have a bilateral CSA and I am in the money, I'm being posted collateral. So I don't have to fund my position because the collateral actually funds my position for me. So therefore I don't need to have a risk-free rate because there's actually nothing to fund. So what I really am interested in is the collateral that the counterparty is giving me. What remuneration do I have to pay on that collateral? And that effectively is the rate I'm funding my asset. So the big change between post-crash and after crash has not really been about the risk-free rate. It's more a recognition of how do I fund the asset on my balance sheet, which is my positive mark-to-market, I know, I'm funding it via the collateral, and therefore I should discount it using the rate I'm paying on the collateral, because that's where I'm funding it. So it's not really a risk-free rate, it's more the funding rate, right?
Totally agreed.
Yeah.
But totally agreed? What's the impact of now going to centralised clearing? That's still in a CSA world.
There's absolutely no difference.
Right. That's just what I want to get clear. Yeah. That's what
The only difference is that when you go to a CCP, there are very strict regulations about what the VM can be in. So it's generally cash in the currency of the underlying asset,
Yes.
and it's OAS reimbursed, the OAS on.
Okay, so that-
But are some of the
Bilateral
stronger
impact.
credits losing some benefit they might have had of being in a stronger position in having one-sided agreements where they were getting more collateral?
I think from a one-sided agreement, you tend to find one-way agreements, supranational, sovereigns, and so on, where they have unilateral. They're not going to clear; they're exempt. So, from a bank's point of view, if I was in the money with a sovereign or a supranational, I wasn't getting any collateral.
No.
So that's a funding cost for me.
It will be, because on the other side, you will have to fund it, and that will be the clearer, and you're not exempt. So
But the introduction of one ways is a real bane, because it gives
And a
rise to
bane.
a funding cost, pain and bane. But they won't be in this. They won't be in centralised clearing.
Right.
World,
I
right?
mean, I
So-
read these studies there's a 2009 study that said Goldman had so much excess collateral. What is it here? They had 110 net collateral, 110 billion net collateral business, and this article claims they were making $900 million a year off their collateral surplus.
I'm sure that's right.
Are guys like that? So you don't think certain banks are going to lose a lot of money on that?
Goldman's famously do not trade with anyone that has a one-way CSA.
Yeah.
Right? They refuse to enter into those type of trades. So the type of trades that they would do are ones that are not only are they two-way collateralised, but also with clients that post an initial margin or independent amount, so they'll be over-collateralised.
So they can demand over
Yeah, they
collateralization
can demand
now,
over
and they're going to lose that or not.
It's going to get they're going to lose that benefit if those trades clear, right? Because they're not going to get the initial margin anymore. It actually is worse than that, because if their trades don't clear and they're under the bilateral initial margin rules, then Goldman's will have to actually post segregated initial margin on trades where they used to have a net funding benefit. Now they don't have that anymore. In fact, it's worse. They have a funding cost.
Wow.
Will Goldman's lose that benefit, or will it just get priced somewhere else?
Goldman's will lose that benefit to the extent that bilateral trades, in the situation where they have a bilateral trade with a counterparty, call it an end user, where they have demanded an initial amount, which is a funding benefit for them, right, over collateralisation. If the new rules say that that portfolio has to be bilateral initial margin on both sides from in a segregated point of view, they not only lose their over collateralisation, but they actually have to post segregated initial margin themselves.
Yeah, sorry,
It's a
but I just
double
mean,
whammy.
from Goldman's point of view, if they were in the position where they could demand that from the other counterparty, don't they just go, the price moves by 3 basis points?
There's no doubt that they will price. There's no doubt that banks will price in the cost of segregated initial margin into their price with their clients. No doubt. It's another function of FVA.
Yes, and so the impact from the hedger, whether it's a corporate or a small bank,
will go up.
yeah, the cost will go up. Absolutely, that's exactly right. So there is the admin issue, there is the technical, there's the settlement, the collateral management, and there's just a basic pricing issue, which everyone should be aware of. And I'm not sure a lot of smaller banks, or indeed large banks that aren't market makers, quite get this. But the price will go up. Absolutely. Let's then tackle this. So Colin's point, if I decided I didn't understand, not that anyone would ever admit this, but if I decided I didn't understand the impact of going through not just the XVAs, but I didn't understand the impact of going through CCPs, and I didn't want to use derivatives, how could I hedge my exposure, my interest? Just to keep it simple, interest rate exposure. Fixed rate mortgages. Could I keep on offering them? How will I hedge them? Or should I think of some other way to hedge them? Or should I simply wear the risk, like you were suggesting? We're have a whacking great IRRBB cap charge on it now, because of the Basel thing. But is that something I'd rather live with than trying to get to grips with all this other stuff?
Yeah, I think, and this is part of the management of your balance sheet, you'll be more incentivised to go in, I'll write 2-year fixed rate mortgages and 2-year fixed rate savings products.
Yes, that's in theory, that hedge works.
Which is the simplification. But again, I mean, it all comes down to what is the purpose of banks, and if one of the roles of what we do is maturity transformation, you start to say, well, that becomes very difficult because you end up one way. Like you said, all the people are one way in terms of your long asset. Well, guess what? You'll just say, well, we can't do long fixed rate assets. And you'll either, if the bank can't hold that risk because of the Basel capital charge, you'll pass it back to the counterparties and go, well, you can't do a 10-year fixed.
Yeah, you'll just stop doing that product.
And so you'll leave the risk in the financial system, but in the non-bank financial
I see what you
system.
mean. So the individual, you and I, we'll just have to run with the variable rate and wear the risk ourselves. Okay, right.
Or pay more.
Or you'll have more shadow banking offering that product.
Yes, absolutely. That's right. Absolutely right. Okay, which we're not here to debate, but it's a very fair point. Which is, I personally think regulators should fear that. Which leads me nicely on to something else that one should fear: systemic risk of CCPs. That was you, Peter. Now, I thought the theory was, a bit like when I do exchange traded futures, I thought the theory was these people are risk-free. That's the whole point of it. So I don't have any counterparty risk when I buy or sell Eurodollar futures because it's with the exchange. That's the whole point. So what is, let's articulate the systemic risk in CCPs. Although, from a practical perspective, does that impact the ALM manager in a bank? I suppose if that person thought there was risk, there's counterparty risk, then it would. What is that? Why is the counterparty risk not zero from the bank's perspective of the CCP? Anyone?
They're going to have to believe that they understand collateral volatility properly, and if everybody's positioned the same way, they're creating the mother of all systemic risks. People have said, the G20 itself just said we have to look at a lot more about the interlink between different CCPs. If one goes, does that mean another one goes? So that's more consideration there. Okay. And then the question is, what if a CCP had a cyber attack? I mean, it's supposed to have a certain amount of capital itself.
Correct.
To survive some its own problems before you start going back to the members.
If you accept that there's a non-zero probability of a CCP failing, which I think everybody will accept that it's not zero, you then go, well, there definitely is a very big risk if that eventuality happens.
Yes.
However remote you think it is, it's non-zero.
So therefore, it impacts my pricing again, right, Massimo?
Yeah, for sure. There have been, let's say, cases of defaults, maybe in the 70s, in the 80s, of the clearing houses, so it's historical proof there. There are many voices that are claiming that they bring more systemic risk. Everybody maybe it's assuming, I don't know if somebody is running stress test assuming that the clearing house is going to bankrupt, probably not, but maybe it will be an interesting scenario to simulate sooner or later. And then there are many technicalities, that must be taken into consideration if your account is segregated or not, and which kind of collateral you are posted, which kind of investment they are, putting in place in order to reinvest the cash and so on. And of course, we have the different regulatory impact, the EMIR on the European side and the Dodd-Frank on the other side. So that there are also, jurisdictional and regulatory consideration to take into account. But I think I fully agree. We have a non-zero risk, if not for operational risk, for cyber attack, for any kind of risk that more or less must be taken into consideration at systemic level.
Okay.
I'd add to that in that I think I talked a little bit about it in the presentation. Yeah, to me, CCPs are just another bilateral counterparty. Okay? I have lots of bilateral risk with counterparties documented under CSA. So I have a particular type of CSA with a CCP. So to me, it's just another collateralized counterparty. The difference being that as I contribute, I post a lot of initial margin, and I also contribute to a default fund. So the default fund gives rise to a risk weighting on which I must capitalise. Now it's non-zero. I think if you go back to Basel 1, it would have been 0. Right? I think in Basel 3, it's 2%. I believe,
Okay.
for a qualified CCP. The point about equivalence is now, they recognise each other, so you don't have a 1,250% risk-weighted asset multiplier. Because they're
That would be the mother of all paradoxes, wouldn't it?
Because they're
CCP, but it's heavily risk-weighted.
But as well as cyber attack, as I said, they have, LCH has £45 billion worth of initial margin which it invests in the markets. Right? There is a non-zero chance of some of those investments going wrong. And so therefore, who's on the hook for that? So there are risks in CCPs over and above just the contribution to the default fund. But the best way to manage them is because your contribution to the default fund is a function of the risk that you bring to the CCP, you manage the risk that you bring to the CCP. And would you rather have X amount of risk with the CCP, or would you rather have it with XYZ Bank? I think most people would say I'd rather have it with the CCP.
Yeah.
Right? But there are ways of managing down your risk in the CCP. They're harder now, as I alluded to, in the fact that mandatory clearing comes down the road. So there are not a lot of tools in my toolkit that allow me to reduce my bilateral risk. But certainly it's either reduce my bilateral risk or the risk with the CCP. But there are some. And as I said, there are active CCP management units, generally the XVA desks, that have been set up to manage the CCP just like any other counterparty.
Right, and that's a key point. I'll come right to you, sir. That's a key point. So we view them as another counterparty, okay, one of albeit lower counterparty credit risk than some of the other bilateral counterparties, but nevertheless it's there. And if you are a big user in this space, for example, a market maker or indeed a large user, then you should have one would always have had it should have had an active collateral management desk, but they also need to be really on top of their XVAs. Okay, so the takeaway for the practitioner, for the ALM practitioner, whether one is in Treasury or collateral management or indeed in the CRO's office, is impact on price. The pricing goes up. So if you're using it for derivatives hedging purposes, you should incorporate that into your customer pricing. Otherwise, you're subsidising one business line with another. And two, treat it like any other bilateral counterparty, albeit one of lower counterparty risk. Now, that's the takeaway so far. If I've missed out any takeaways. Okay, at this point, it's a good point to open up to the audience, and we have a question straight away, sir.
Well, just CCP is not only conditioned by CBA or counterparty credit risk, also the impact on the liberal trade is so important to push the entities to try to move the operation through a CCP. In relation to operational risk, we don't need cyber attacks. In 2015, during 5 days, the largest pension funds doesn't have the valuation of the asset for error in a migration of the system in one of the bank that provide the custody service. That's the accident that in the systems, in the fact we need to ask every day how the systems are working. But this is really a miracle that I think that is not only aggression like a cyber attack, we have a risk itself in the transactions.
Yeah, absolutely. Any comment? I mean, operational risk of all kinds is with every institution in the city, every institution full stop, right? I'm not sure, there's a reg. I mean, a reg cap for me. A reg cap charge is actually irrelevant. A cyber attack or customer fraud or a staff fraud or whatever your IT systems fall over. It almost becomes relevant what the capital amount is because it could be far too high or never far too low. Any comment on that, or were you just making an observation? Yeah. Okay. Any other questions? Yes, sir.
Yeah. I'm just curious as to what happens to the price discovery for buy-side institutions and even for interbanking market. I think Kevin was pointing about the screen prices from LCH, for example. But when the CCPs really arrive and when everything is clear, I mean, how do you find out 10-year swap rate in Bloomberg? What you see is that the rate you're going to be dealing at what conditions really?
So the point I was making was that the price you see on the screen, right, it had to reflect something, right? So the observed price, what does it represent? And the market practice is for the observed price that you see on Bloomberg or ICAP or wherever, is for a CCP, or specifically LCH cleared trade. If you want to do anything other than clear at LCH, you want to do it bilaterally or clear in the CME or clear at Eurex, there's a different price. And that's where you get the basis.
But then you also mentioned about the collateral being posted, and whether internally within the bank, the collateral being driven by the trading desk or the treasury. and or the counterparty risk you talked about, right? So how do you, so at Bloomberg or ICAP, you see the LCH price. What do you add on? You add on a specific situation of the offered, the dealer, plus the specific situation of the buyer or the buy-side institution. How do you kind of, address that pricing?
So as I said, the price is for a cleared swap.
Yeah.
If you're doing anything other than clearing the swap, then the price is going to be different.
Yeah.
Right? The extent to which the price is different will vary from institution to institution. We talk a lot about CTD collateral. And this concept of CTD collateral is going to vary across institutions. If I happen to be a pension fund that's got bonds, let's say I'm a UK-based pension fund, and I've got gilts coming, gilts and highly rated corporate, UK corporate paper, that is going to be easier for me to pledge than it is sterling, cash. So CTD for me is I want to pledge the bonds that I have. If I have to repo those out to raise cash, people are going to charge me balance sheet usage now. It's a lot higher than it used to be. Is there always going to be a repo market? When I really want it, is there going to be a repo market there? No, probably not. Okay, so to be prudent, I'm going to run some form of liquidity buffer to give me cash should I should I demand it. So the price for that institution is going to be different. The whole CTD conversation is going to be different than if I am doing the same business but in another bank. So in order to calculate what the price on the screen represents, it represents the fact that you fund, if it's a sterling swap, that you're going to fund it in SONIA, because you're going to earn SONIA on the collateral you post. Can you fund in SONIA? That's the first question I would ask. Right? If I can't fund in SONIA, if I can't repo assets at SONIA, because they're now SONIA Plus, which is bizarre, then I have to put an extra cost on that myself. But it's peculiar to me. Right? So I talk about XVAs being in the eye of the beholder. Right? So the approach to pricing, the approach to XVAs depends on my circumstances, and my circumstance will vary depending on what institution I'm sitting in. I just came from a buy-side client today. Their situation is very different to if I was sitting still at RBS, right? Or if I was a big European bank or end user. Lots of access to euros, but I've got to post sterling. Well, I haven't got any. Right? So the idea that sterling is cheapest to deliver on a sterling trade, well, that's nonsense, because I haven't got any. I've got loads of euros. So, and I don't have access to the repo market, I don't have access to the FX market, I just want to post euros. So for them, the decision about what's cheapest to deliver is different.
Yeah.
And that's the point I was trying to make. So to answer your question, it's in the eyes of the beholder.
Yeah, and if you're the big pension fund and you've got a choice, you go, I'd much rather pay 1 basis point and give you the collateral that I've got, than go, well, I can save 1 basis point, but I've got to do all this and create a whole industry, and net, it doesn't add any value. If you're telling me that the cost is 30 basis points, that's
then
when
I
I go,
might do it,
well, actually,
yeah.
it's probably worth me doing this and working out what the cost is. And so it's cost-benefit analysis, isn't it?
And it'll be different for each firm.
Yep.
Sorry, go on.
Can I just ask a follow-up question, please?
Yeah, of course.
So what happens to the corporates or sovereign institutions who are not going to be posting any collateral and they are exempt for clearing? So obviously, those prices would be much higher than for the buy-side institutions who are clearing.
I would be surprised if just because mandatory clearing comes down the pipe, that the price for the end user who doesn't clear is going to change. I would argue it's changed already, right? Because if you're an end user and you're not going to post me collateral and you're not going to clear, I've known that for a long time, right? So you're not posting me any collateral, I'm going to charge you an FVA. You're not collateralised, so I have a bigger CBA, I'm going to charge you that. I have always charged for capital, right? Whether it's a hurdle or a threshold or whatever. I may now have made a more robust calculation of what that capital cost is, taking into account the CBA VAR and some of the move to SACCR and some of the other regulatory changes. So I may have a more robust calculation, but I've always charged you capital. Right? I've always charged you for funding. I've always charged you. So just because we're going to go to CCP clearing, I don't think it's going to make any change at all. The end user's already paying it. They probably just don't understand.
Yes. Yes. Okay. Any other comments or questions? Yes, sir.
just off the topic, but this UK banking ringfencing and CCP, and how do you think it will play and it will affect KLM managers' functions?
Good question. Ring fencing, when it first came out, if you'd asked me, I'll just invite some comment from the panel on this actually. If you'd asked me, I would have said, I would have done this, and the other. However, I think by the time we get to it, it might have been watered down to a point where it doesn't have the impact, and CCP and use of derivatives doesn't have the same impact that it would have in the way that Vickers would have intended when he published it. You see what I mean? I don't think, as it stands, you'd have two separate institutions have to deal at arm's length with each other. So there's the fact that they're somehow linked is irrelevant, and they just act as standalone banks. But I think that looks like it's going to be watered down. So I would say
She's complaining about.
yes, but
But I think you put it the other way, which is Vickers hadn't intended it to have the impact on the market because he was only looking from the
yes,
purely protecting the retail deposit
right.
side.
And being an academic who had never worked in a bank, he saw the purity of doing that to protect the retail arm without realising that if I was a shareholder, why would I want to have shares in an institution where one part of it I have no control or influence over whatsoever? I don't think he thought that through. But that's why I think it's difficult to answer that today. 5 years ago I would have said, oh, it's going to be this, and the other. But I'm not sure. Anyone else have an idea on that? I don't think it gets implemented the way he intended. That's my view.
The only thing I'd add is at the moment, whether it's, if I'm Deutsche Bank and I'm trading with RBS, and I use RBS as an example, on a 10-year swap, I don't care whether it's Treasury or the trading desk who want the price. I'm just trading with RBS. It's one ISDA, it's one CSA, and I used the analysis earlier about where that boundary issue is about who owns the collateral as to whether or not Treasury lose out or make in that transaction. If you go to a totally ring-fenced institution, then you'll have a new CSA with Treasury, because they'll be on one side of the fence and your trading business will be on the other. So they are two different entities. You will have two different CSAs. Presumably, you'll have two entities clearing, but that's if they go down the full route.
Yes.
And I don't know if they will.
So it's reducing the efficiency of the collateral optimization process across the group. So it might be a negative effect because the example in which we said during the presentation, in which one unit is long of collateral, the other is short, they cannot simply net the position.
No.
They need,
No.
to face it on a gross basis.
Yeah.
Okay. Thank you. Any other comments? Okay. Well, thank you for that, gentlemen. Appreciated that. I hope that was of some value. I think, I would like to re-summarise what I did a few minutes ago and said the takeaway for us as practitioners in ALM, and if we are users of derivatives, is the price will be impacted. We need to be aware of counterparty risk, no matter how minuscule, on the clearing agent. Sorry, the clearer, centralised clearer. And we need to really understand collateral management and XVAs. I would suggest all three of those are areas that the market as a whole is not really 100% up to speed on. Anyone want to add anything to my summary?
I meant to bring it with me, but I didn't. One of the things that we do at Solum is we have generally on an annual basis a market survey where we ask the top 25 banks what they're doing on a particular subject. And over the last few years we've done 2 on the CVA, 1 on FVA, and the latest one was on collateral management. So what we get is best market, from the top 25 banks we get best market practice. I was going to bring the collateral management one and the FVA one with me, but I forgot. But
Next time.
But they're available on the Solum website if you want to go and have a look. They're download. You can freely download them. Have a look, and then if there's any follow-up questions, you can always ring me, and I'm happy to
Excellent.
have a chat. But on the Solum website. So.
Thank you, Mr Liddy. No, that's of value. I'll be taking your slides from tonight and posting them on BTRM anyway. But thank you for that. Anything else want to add to that, Mr Eisenhart? You happy?
Happy.
Massimo, thank you. I'd like to thank the panel then, Peter Eisenhart, Massimo Petroni, Colin Johnson, and of course Kevin Liddy. Thanks very much and have a good night. Thank you, chaps. Appreciate it.